Hello everyone, welcome back to the investment side of the channel. So one of the viewers actually asked what I think about consumer staples which may be more recession proof because I mentioned in the last video that a recession may possibly come in the near future. To which I responded that generally consumer staple stocks are more recession proof and less volatile than tech or AI stocks. So in this video, let's find out if consumer staple stocks are indeed more recession proof and why I think holding too much of these recession proof stocks may be detrimental to your portfolio. And lastly, my favorite, which is the hypothetical value of investing your precious $10,000 and what happens after 25 years, which was very shocking to me as well. And a small bonus for those who watch until the end. So part 1, are consumer staple stocks really more recession proof? So before we start, we'll be using XLP and XLK, which are just ETFs that track consumer staples like a Walmart, Costco, Coca-Cola, and your Pampers for XLP. And for XLK, it is just an ETF that tracks your typical tech stock like Nvidia, Apple, Microsoft, Broadcom, Palantir, and many other tech-related stocks. So now that we know what is XLP and XLK, right, let's go back to the question of whether consumer staple stocks are indeed more recession-proof. So if you see on the chart, right, so during the dot-com bust era, if you look at the first row of the table, you can see that when S&P 500 dropped by 49% and when tech stocks got absolutely destroyed by 82%, consumer staple stocks actually did not move at all. So, and this trend actually repeats itself, such as during the global financial crisis, where the worst brothers you can have collapsed, and during the COVID-19 crash, and also the latest bear market in 2022, where we can see that the trend actually repeats itself. So, whenever the market drops, consumer stocks actually simply drops less than tech stocks or even the S&P 500. So next, you may ask me, right, why do these consumer staple stocks drop less than tech stocks during recessions? So one way to think about it is, right, I don't need to buy a new iPhone 30 Pro or something during a recession, but I'll still need to go to toilet bang sai, right? And I'll still need to bathe, and I'll still need to go to Sheng Siong to participate in the buy pay, right? So in other words, right, consumer staple stocks do maintain a steady demand even during economic downturns, while tech stocks generally are tied to business cycles and are more cyclical, and they are more vulnerable during recessions. And then you might say, hey, solid leh, wow, during recession, my portfolio won't drop at all. Let's go all in Coca-Cola and Walmart. So in part 2, right, before you go all in on consumer staple stocks, let's explore why I say holding too much recession-proof stocks may destroy your portfolio in the long run. So why do I say that holding too much of these recession-proof stocks may be detrimental to your portfolio, right? Is if you look at annualized returns for these three indices that we are comparing today, you can clearly see that XLP has consistently underperformed both the S&P 500 and the XLK technology ETF. And this is consistent as well throughout the 1 year, 5 year, 10 year, 20 years, and even a 25 years period. Then you may think, only few percentage only what, right? What's the difference between 9.18, 9.5%, and 13.27%? Got difference, meh? So let's go to my favorite part, the 10K illustration. So how much money do you think you would have if you invested $10,000 into these three different ETFs after investing for 25 years? So actually, if you invested $10,000 into S&P 500, XLP and XLK 25 years ago, you would have $96,000 if you invested in the S&P 500. And if you invested $10,000 into XLP, the consumer staples, you will have $89,862. Or lastly, for XLK, you will have $225,000. So that's a staggering difference of $135,000. So in summary, a reminder that this video is just me rambling about finance-related topics and not financial advice. But in this video, we have shown that consumer staple stocks are indeed more recession-proof in the sense that the drawdowns are not as severe as tech or AI-related stocks and even the S&P 500. But we have also proven that consumer staple stocks tend to underperform the tech and even the S&P 500 by a huge margin over 25 years of backtesting. So perhaps underperformance is the price that you have to pay for the stability that you get. So to me, if you want to invest in consumer staple stocks, one question that you have to answer is whether do these consumer staple stocks have pricing power on and moat or not. So to me, right, they do not have a pricing power and they do not have moat at all. So with online shopping like Shopee, Amazon Fresh, RedMart, and for Singaporean context, right, Sheng Siong, NTUC, Giant, there are many other ways and platforms that I can compare prices and simply get the lowest one. So yes, even in recessions, I can simply buy cheaper products, especially after opening my trading app, right? And everything is just red. So the second question that you have to answer is whether the companies are able to grow. So effectively in investing, right, especially when your capital is small, you want the company to grow so that your wealth can also grow and compound as quickly as the company. So the third question you have to answer is, are the dividends given by consumer staple stocks worth it or not? So XLP actually gives out 2 to 3% dividend yield. So if you have $10,000, you will actually get $200 to $300 worth of dividend per year. But you have to ask yourself if you can survive or grow your wealth with that $200 or $300 per year. So I think the answer is quite clear. So unless you are in the 7-figure net worth range, I suggest not allocating a large sum of consumer staple stocks to your portfolio, as it will probably serve you better to own some tech stocks in the long term. But of course, that being said, right, the last point that you have to ask yourself is if you're okay with the volatility of tech stocks. Investors always think they're okay with volatility until they are not okay with volatility. Okay, and lastly, thank you for watching till the end. I will leave you with the bonus. Do you know who these three guys is? And these three guys are actually the bosses of Sheng Siong. Ticker symbol OV8. But don't worry, I also never buy. So on hindsight, right, maybe it was a sign to buy the stock when we were looking at Zhongxin shouting 百倍, right? Because it has went up more than 700% since IPO in 2011. So what I want to say is that, right, not all consumer staple stocks are built equally. So if you really want to invest in a consumer staple stock, you might need to study in detail the company's expansion plans, balance sheets, growth, to be able to beat the market. So if you think I earned it, remember to hit the like button and subscribe to the channel as well. So like usual, stay safe out there and I'll see you on the next one. Bye bye.